What if I told you the stock market is hitting record highs, while millions of Americans still feel financially stressed? Inflation is still hurting families, credit card debt is exploding, and housing is becoming impossible for average people. Yet, Wall Street keeps celebrating like everything is perfect. So, what's really going on? Is this economy stronger than ever? Or are we living inside one giant financial illusion? In today's video, we're breaking down why the stock market feels completely disconnected from reality and why so many investors are starting to feel nervous right now. Welcome back to the Dollar Pilot. Right now, the American economy feels deeply confusing. On one side, the S&P 500 and NASDAQ continue pushing toward all-time highs. Tech stocks are booming. Artificial intelligence is driving massive investor excitement, and headlines constantly talk about a strong economy. But on the other side, millions of Americans are struggling with inflation, rising rent, expensive groceries, and growing debt. That disconnect is exactly why so many people are asking the same question. Why does the stock market feel fake right now? The truth is, the stock market is not always a reflection of everyday life. The market is forward-looking. Investors don't just price stocks based on what's happening today. They price them based on what they believe will happen in the future. And right now, Wall Street is betting heavily on one thing: artificial intelligence and future corporate profits. Companies like Nvidia, Microsoft, Apple, Amazon, and Meta have become the driving force behind almost the entire stock market rally. In fact, a small group of mega-cap tech stocks now makes up a huge percentage of the S&P 500's total gains. That means even if the average American business is struggling, the market can still move higher because a few giant companies are carrying everything. This creates a very strange situation where the stock market looks healthy, but the average person does not feel financially secure. And honestly, Americans have good reasons to feel stressed. Credit card debt in the United States recently hit record highs. Mortgage rates remain elevated compared to recent years. Car insurance, healthcare costs, groceries, and rent have all increased dramatically since 2020. Even people making good salaries often feel like they are barely keeping up. This is why many middle-class Americans feel disconnected from the strong economy narrative. Another reason the market feels fake is because of how dependent it has become on Federal Reserve policy and interest rates. Over the last decade, markets became addicted to cheap money. When interest rates were near zero, borrowing was easy, and investors poured money into stocks, real estate, crypto, and tech companies. Now the Federal Reserve is trying to fight inflation while also avoiding a recession. Investors constantly react to every speech from the Fed, every inflation report, and every jobs number because the entire market is trying to predict future rate cuts. Sometimes the market goes up on bad news, sometimes it goes down on good news, and for average investors, it can feel completely irrational. But this kind of environment is not new. History shows that markets often become disconnected from public sentiment during major technological shifts or periods of economic transition. During the dot-com bubble of the late 1990s, stocks soared even when many companies had almost no profits. During the housing bubble of the 2000s, people believed real estate prices could never fall. Today, many people believe artificial intelligence could become the next massive economic revolution. Investors are pouring trillions into AI infrastructure, semiconductors, cloud computing, and automation because they believe these technologies will dominate the future economy. Now, that doesn't automatically mean the market will crash tomorrow. In fact, many of today's biggest tech companies are incredibly profitable. Unlike the dot-com era, companies like Microsoft, Apple, Alphabet, and Nvidia generate enormous cash flow. They are real businesses with real profits. But valuations are becoming stretched. The price-to-earnings ratios of many large companies are far above historical averages. That means investors are paying extremely high prices today because they expect even larger profits tomorrow. And whenever expectations become too high, markets become vulnerable. This is why the market feels emotionally unstable right now. One week, investors fear a recession. The next week, they fear missing out on another rally. Social media makes this even worse. Every day, people are bombarded with predictions of either a total financial collapse or a non-stop bull market. Fear and greed move faster than ever before. But long-term investors need to remember something important. The market rewards discipline far more than emotion. Trying to perfectly time the market is incredibly difficult. Most people who panic sell during volatility end up missing the recovery. Historically, some of the best stock market gains happen shortly after major drops. That's why many successful investors focus on dollar cost averaging instead of chasing headlines. They consistently invest through both fear and optimism. And honestly, this strategy has historically outperformed most emotional trading. Now, does that mean risks don't exist? Of course not. America still faces serious financial challenges. National debt continues growing. Housing affordability remains a major issue. Inflation has permanently changed household budgets for millions of families, and geopolitical tensions continue creating uncertainty in global markets. But markets are always climbing a wall of worry. Even during economic uncertainty, corporations continue adapting, technology continues advancing, and long-term productivity continues growing. That's why the stock market can sometimes rise even when public confidence feels low. So if the market feels fake right now, it's because many Americans are comparing Wall Street to Main Street, and those two realities don't always move together in the short term. The biggest mistake investors make is assuming today's emotions predict tomorrow's outcomes. Sometimes the market crashes when everything feels amazing, and sometimes the market rallies when everything feels terrible. That's why patience matters. At the Dollar Pilot, the goal is not to spread fear or hype. It's to stay focused on data, long-term investing, and financial discipline. Whether markets go higher or lower from here, emotional reactions usually hurt investors more than volatility itself. The reality is simple. The economy is complicated. The market is emotional. And building wealth is still a long-term game. Stay informed, stay diversified, ignore the noise. And remember, the people who usually win financially are not the ones predicting every move perfectly. They're the ones who stay consistent when everyone else panics.